Make sure to hit that subscribe button and turn on notifications. By subscribing, you'll get access to more videos packed with valuable content on financial intelligence.
Ron and Betty have been successful real estate investors throughout their lives. In fact, they had been so successful, it was now time to plan distributions in such a way so that their children, and not the IRS, were the proper beneficiaries. Ron and Betty purchased a strip center many years ago for $100,000. The center was now worth $500,000, and the mortgage had been paid off. Knowing that they wanted to transfer assets to their two children, Kenji and Cindy, they met with a 1031 exchange expert to devise a plan. The first step was to sell the strip center for $500,000 and enter into a 1031 exchange whereby Ron and Betty acquired a 50% interest in new property A. The new property was worth $1 million and was 50% owned by the children, Kenji and Cindy. Ron and Betty's contribution was the $500,000 in cash from the sale of the strip center, while Kenji and Cindy's contribution was a promissory note secured by a first deed of trust on the property for the remaining $500,000. The 1031 exchange expert explained that even if Ron and Betty owned 100% of the strip center, it was acceptable for them to only own 50% of new property A. There were two key points to consider in the transaction. The first was that for Ron and Betty to defer capital gains taxes, they had to buy a property equal to or greater in value, which they did. The strip center was worth $500,000, and new property A was worth $1 million. The second point was that they had to take title in the same name as they held in the strip center. Ron and Betty always used limited liability companies, or LLCs, for asset protection purposes. For new property A, they used a tenants in common structure, whereby Ron and Betty's LLC and Kenji and Cindy's newly formed LLC were listed in title as tenants in common owners. As long as these points were satisfied, Ron and Betty were okay and ready for the next step. After a year and a day of holding on to new property A, the family began looking to trade up to new property B. In another 6 months, they located the right property in a desirable area. New property A had appreciated, and it sold for $1.2 million. New property B was purchased for $2 million. Ron and Betty's contribution was their $600,000 share from new property A. Kenji and Cindy, meanwhile, used their $600,000 share of new property A to purchase a $1.4 million interest in new property B. As such, in the new property, Kenji and Cindy owned a 70% interest, $1.4 million of $2 million, while Ron and Betty's interest is reduced to 30%, $600,000 of $2 million. Obviously, one can appreciate where this is headed. After 2 more exchanges, Ron and Betty could, for example, own 12% of a $5 million new property D. Kenji and Cindy, on the other hand, would own 88% of such a valuable property. And remember, neither the parents nor the children have paid capital gains taxes as this transfer of wealth has occurred. And because Ron and Betty own such a small percentage of new property D, their ownership interest may be subject to IRS-sanctioned discounts. This is because the IRS prudently recognizes that even though 12% of a $5 million property may be worth $600,000 on paper, no investor is going to pay that kind of money for a property where they have no say in management or control over major decisions, such as selling the property. So the IRS generally agrees that such a lack of control may account for a 10 to 30% discount. Let's say a 30% discount, meaning that Ron and Betty's 12% is really only worth $420,000. This discount gives Ron and Betty the option of gifting their interest tax-free at $12,000 per year at this recording to Kenji and Cindy over a period of years. With Ron able to gift $12,000 each to Kenji and Cindy, and Betty able to do the same, a total of $48,000 per year, $12,000 per gift, times 2 parents, times 2 children, could be gifted away. Assuming new property D didn't wildly appreciate, thus driving up the value of Ron and Betty's 12% interest, the gifting could be accomplished over a 10-year-plus period. That is $48,000 per year in gifts to gift out a mildly appreciating $420,000 discounted interest in new property D. Or Ron and Betty could decide to wait until their passing to bequeath the remaining 12% interest to Kenji and Cindy, according to their wills, living trusts, or other estate planning vehicles. With the tax-free exemption for federal estate taxes at $2 million for each of their estates, as of this recording, Ron and Betty, assuming they had no other significant assets, could pass the remaining 12% in new property D to Kenji and Cindy tax-free. Of course, you'll work with your own tax and legal advisors on your own situation. But the point to take away here is that Ron and Betty, starting with just a $100,000 investment in their original strip center, were able to pass along a $5 million asset tax-free to their children through the effective use of 1031 exchanges and estate planning strategies. You can too. Now let's review real estate and retirement planning. Most Americans are concerned that company pension plans and Social Security will not adequately provide for them in their retirement years. Over the last 10 years, Congress has approved increasingly beneficial retirement options designed to encourage Americans to save on their own for their golden years. While no congressman will dare utter the fact that Social Security and Medicare are now regarded by many as Ponzi schemes that can never be fixed, Congress has covered itself with retirement legislation. So that 20 years or so from now, when the government system breaks, Congress will be able to shake its finger at the American people and point to the IRAs, 401ks, Roth IRAs, and the like they have created. What will not be addressed is why the government continued to take 15.3% in payroll taxes from the workers and businesses for a failed system. But that's an issue between you and the ballot box. The point is that to provide for your own retirement, it is prudent to rely on yourself and not on the government. A case helps to illustrate how retirement plans can be used for beneficial real estate investing. As an enrolled agent and tax preparer, Jeremy knew the rules about retirement plans. And he knew that since Congress kept raising the amounts one could set aside each year, he should take care of himself. The message was clear that no one else would. So, over the years, Jeremy had amassed an IRA valued at $125,000. The account was invested in mutual funds and bond funds, which, in the last few years, were only generating a 4% return. After factoring in the effects of inflation, it was not a stellar return. Granted, the returns were accumulating tax-free into his IRA, but Jeremy knew he needed a great deal more money to retire on, at least $1 million. And he knew that because this was a traditional IRA and not a Roth IRA, he would be taxed on the monies when he started withdrawing them from his IRA for his retirement needs at the higher ordinary income tax rates, thus further increasing the money he needed. So Jeremy started looking for a better investment return. Many of his friends had done well by investing in real estate, and his good friend Terry had even successfully invested in real estate using his IRA. This was intriguing, and it led Jeremy to his first real estate investment. Jeremy knew his market and decided to stay local with his investing. He also knew that when the new freeway to the northern suburbs was eventually built, land values would skyrocket. But because people had talked about the project for years and nothing had been done, land values were still surprisingly affordable. And yet it didn't take 20/20 crystal ball vision to see that the road would someday be built. The traffic on surface streets during commute hours was getting worse. Quiet neighborhoods were not so quiet anymore. Political pressure for a freeway into downtown would certainly increase. So Jeremy found 2 acres of land near a proposed off-ramp for the freeway. It was selling for $100,000. He arranged for a trust company to set up a self-directed IRA, which is an IRA that can invest in a wide variety of assets. The trustee then set up a limited liability company, or LLC, to hold title to the property for asset protection purposes. This will be discussed in greater detail later. For now, please note that if the IRA took title to the real estate in the name of the IRA and a claim arose involving the property, a judgment creditor could reach not only the real estate, but the remaining $25,000 in Jeremy's IRA. By using an LLC, the remaining IRA assets are protected from attack. Jeremy's IRA purchased the 2 acres and waited. With the $4,000 in annual contributions he used to fund his IRA each year, he had the trustee pay the $1,500 a year in property taxes. The remaining $2,500 went into his IRA and was held in an interest-bearing cash account as a reserve for any expenses that came up on the 2-acre property. It was Jeremy's strategy to contribute the maximum amount possible to his IRA. The current maximum for any IRA, be it a Roth or a traditional IRA, was $4,000. When Jeremy reached age 50, he could put in an additional $1,000 a year. These amounts, Jeremy believed, would increase over time. Jeremy knew he needed a lot of money for retirement and funded the maximum amount each year. Jeremy's patience was well rewarded. 6 years later, the freeway was built through to the northern suburbs. Jeremy's acreage was very well located and eventually sold for $1 million. That money went tax-free into his IRA. At age 59 and a half, Jeremy began to pull money out of his now $1 million plus IRA account. Because he had used a traditional IRA and the initial contributions were made with pre-tax dollars, he had to pay tax at ordinary income rates when he took the money out. The Roth IRA, as we'll discuss later, is the opposite. So if Jeremy's tax rate at age 60 was 20%, he would pay the IRS $2,000 on every $10,000 withdrawal from his IRA. Jeremy's case illustrates the advantages of using IRAs to invest in real estate, but it also highlights a tax disadvantage. What if Jeremy had used his own money instead of his IRA money to invest in the land? Or what if he used money from a Roth IRA? Would there be any tax difference? The answer is yes. If Jeremy had purchased the property using his non-retirement after-tax dollars, he would be subject to capital gains taxes of just 15%. Remember, he held the property for over 1 year, so that the lower capital gains rate versus the ordinary income rate for a less than 1 year hold would apply. As we've seen, this 15% capital gains rate is less than the ordinary income rate that an IRA is taxed at upon withdrawal. So in many cases, you'll want to consider using your own money to buy highly appreciating real estate. So how can you use an IRA in a more tax-advantaged way to acquire real estate? The answer, which we've alluded to, is to use a Roth IRA. A self-directed Roth IRA, with a trustee investing in real estate through an LLC, can be an excellent tax vehicle. Remember, we said that a Roth IRA is made up of after-tax contributions. And because you paid tax on the money going in, you don't have to pay tax on the money coming out. So if Jeremy had used Roth IRA money to buy the 2 acres, the $1 million upon sale would not be taxed. And when Jeremy began to pull the money out at retirement, there would be no tax. It is almost too good to be true. Of course, when we hear those words, we're all trained to ask, what's the catch? And there is a catch. But there's also a positive exception after the catch. The catch is that, as of this recording, only people earning $150,000 a year or less can contribute to a Roth IRA. So at the start, high-income earners were excluded from the generous tax benefits of a Roth IRA. But remember how we said that Congress is getting more and more generous with retirement legislation as it becomes clearer and clearer that Social Security is probably beyond repair. As of 2006, anyone at any income level can contribute their after-tax dollars to a Roth 401k. This is big. Plus, 401k plans, whether Roth or regular, allow contributions at this recording of $15,000 per year, with workers 50 or older able to contribute an additional $5,000 per year. And while a Roth 401k, as an ERISA plan, does not allow for investments into real estate, you can in many cases roll your Roth money from a Roth 401k plan into a Roth IRA plan. Once there, you can use your Roth IRA to invest in real estate. And from there, you are given some excellent planning opportunities, such as allowing your beneficiaries, like your children, to draw out money tax-free from your Roth IRA after you have passed on. With all the benefits available, it is important to know the landscape of plans. Here are some key questions and answers. Which retirement plans can invest in real estate? Retirement plans such as IRAs, KIOs, SEPs, and Roth IRAs are not subject to the same limitations as ERISA plans. ERISA stands for the Employment Retirement Income Security Act of 1974. So while ERISA plans, such as the popular 401ks, cannot invest in real estate, IRAs can. What type of real estate is an acceptable IRA investment? Your plan can invest in raw land, subdivided or improved land, single-family homes, apartment buildings, multi-unit homes, co-ops, and commercial property. Can an IRA use debt to acquire real estate? Yes, but there are several restrictions. First, the loan must be non-recourse, meaning that the lender may look only to the IRA-owned property as security for the loan. If the loan isn't paid back, the lender can proceed only against the property, which is good for you, the borrower, but is also a reason why not many lenders make non-recourse loans. They want as much security as possible. Of course, you would too. Another restriction is that you, as the plan beneficiary, cannot personally guarantee or even sign for the loan. As such, the plan and your plan trustee must sign the loan papers. Not all trustees are going to do this, so check ahead of time as to what your trustee is willing to do to assist in the securing of financing. Another issue is that any income or profits related to the loan are subject to UBIT taxes. UBIT stands for Unrelated Business Income Tax. It is the tax on income and profits related to your leveraged or financed part of the transaction. So for example, if you purchase a property for all cash, meaning there's no financing involved, you will not have a UBIT issue. If financing is involved, the tax is based on net income after all expenses and deductions are taken into account. Your first $1,000 of net income is not subject to the tax. What are the disqualified person and prohibited transaction restrictions? Your plan cannot buy real estate from a disqualified person or enable an investment for yourself or another disqualified person. Your plan may also not purchase real estate and then have a disqualified person use it while the plan owns it. A disqualified person includes the owner of the plan, the owner's spouse, the owner's descendants, children, or ascendants, parents, the spouse of a descendant, a daughter-in-law or a son-in-law, a fiduciary of the plan or person providing services to the plan, an entity where at least 50% of the beneficial interest is owned by a disqualified person or an aggregate of disqualified persons, such as 50% or more of the entity is owned by one or more disqualified persons, or a 10% owner, officer, director, or highly compensated employee of such an entity. Remember, because the property must be purchased for investment purposes only, your business, your family members, except siblings, or you may not live in or rent the property while it is in the plan. Steer clear of promoters who would put you into a prohibited transaction. Such transactions include using your IRA as security for a loan, borrowing money from it, selling property to it, buying property for personal use, or receiving unreasonable compensation for management of the property. What are RMDs? RMD stands for Required Minimum Distribution. While you're free to start withdrawing money from your IRA upon reaching age 59 and a half, you must start receiving RMDs by April 1 of the year following the year you reach age 70 and a half. The RMD changes each year and is determined by dividing the account balance as of December 31 of the previous year by the applicable IRS life expectancy tables. As a general rule, the older you get, the more you must withdraw. Your IRA trustee or administrator can assist you with calculating your RMD. It is important to note that Roth IRAs are not subject to RMDs during the participant's lifetime. They are, however, subject to RMDs after the owner's death. Now let's consider another excellent tax strategy for purchasing real estate. Here's a case where a smart investor used pre-tax dollars to buy real estate. Acquiring real estate for his own account, he had never known about a tax advantage strategy for buying business real estate. This secret was revealed to him when he met with an attorney about asset protecting his duplexes and fourplexes. The attorney asked about protecting his business real estate, assuming that Carlos owned the standalone aquarium retail building he used. When Carlos said he leased the building from crusty old Hector, who would never fix anything on time, the attorney smiled and said he had the last tax-advantaged real estate acquisition loophole for him to consider. Carlos was interested. The attorney explained that Carlos needed a location for business operations. A location, be it a retail store, an office building, a warehouse, or even an equipment storage yard, was a business necessity. As such, rent was a necessary business expense that had to be paid first before profits were calculated. With rent as a write-off, why not rent to yourself? Or why not let your business, which used pre-tax dollars for rent, buy you, the new landlord, a piece of real estate? The light was coming on for Carlos. He asked the attorney to chart it all out. The attorney complied with the following. Carlos would find a new location to purchase for the aquarium business. Once the new spot was located, Carlos would form an LLC or LP, a limited partnership, to acquire the property. He would use after-tax dollars for the down payment on the building. Using pre-tax dollars from the business for the down payment would be inappropriate and could lead to a finding that the business owned the building. The attorney explained that for asset protection purposes, you wanted the real estate to be separately owned. In this way, if the business were sued, the real estate would be better protected, since it would be an asset owned in a single-purpose LLC, separate and apart from the business. After Carlos paid the down payment with his own funds, the rest of the payments, the mortgage, utilities, property taxes, and the like, would be paid by the business. The beneficial use of pre-tax dollars was underscored by the attorney. These were monies that the business could write off before calculating its profits. These were full 100-cent dollars put to good use, increasing Carlos's real estate portfolio. There was no limit to the number of locations the business could buy for Carlos. If he wanted to expand into a second location in the fast-growing west side of town, after paying the down payment, the business could pay the mortgage and buy Carlos another commercial property. Some of the world's largest corporations do the same thing. There was no better example of this strategy than McDonald's. As the company expanded through selling franchises, most often it would own the real estate under the franchise location. For while being known for flipping burgers, the company didn't flip its properties, and as a result, McDonald's now owns billions and billions of dollars in real estate around the world. And what works for McDonald's can work for you. Carlos liked the whole strategy. He asked the attorney what other work had to be done to cement the deal. The attorney suggested that a lease between the business and the LLC owning the property would be appropriate. He also suggested that the business make one payment to the LLC each month. The LLC, from its own separate bank account, would then pay the mortgage, insurance, and the property taxes. While the business would still pay the utilities and other operating expenses, the attorney noted it was important for the LLC to be seen as a distinct and separate entity. Carlos found a new location for his business and started having his business buy him real estate with pre-tax dollars. Now let's review a tax strategy involving charity. A charitable remainder trust, or a CRT, is a way for a philanthropic-minded owner of a property that is greatly appreciated in value to earn an income tax deduction, contribute to a worthy charity, and provide an income stream for beneficiaries, all at the same time, and while the property owner, donor, is alive. Here's an example of how it works. Tyson thought he had it all in 1999, a great job, a big and ever-growing stock brokerage account, a fat 401k plan, and the vision and means for a luxurious retirement in paradise. By 2002, everything had changed. The great job was now grating on his nerves with worthless stock options offering no incentive, the brokerage account was broke, the 401k plan was thin, and retirement was a distant vision. Tyson would be working for a lot longer than he ever anticipated. But Tyson had made one smart and totally unintended investment decision along the way. He lived in Albany, California, a quaint, small, and desirable city north of Berkeley along the east side of San Francisco Bay. He had purchased his two-bedroom bungalow-style house in 1982 for $95,000. He was single, the house was comfortable, and he liked the neighborhood and his neighbors. Until the rowdies moved in next door. They were students at the nearby University of California. 6 of them lived, laughed, and yelled in the adjoining two-bedroom bungalow. The wild neighbors consistently proved that the music of Aerosmith and the Grateful Dead did not get any better the louder it got. All of the neighbors, led by Tyson, complained to the absentee landlord, the police, the community board, and the city council, and to whoever else would listen. Finally, a city councilman dropped by Tyson's house during an all-night party at the Animal House bungalow next door, and the government wheels began to move. The owner of the bungalow was getting sick and tired of the nasty neighborhood letters and police complaints. When the city councilman called demanding a solution to the problem, the landlord offered to sell the house for $125,000, a price that was $15,000 above market in 1985. When this high-handed solution was offered to the neighbors, no one bit. Except Tyson. He bought the bungalow next door. Over the years, he rented the bungalow to quiet professors and solitary writers. But then a funny thing happened. As Tyson's high-tech options, stocks, and retirement began to fade, the bungalow began to appreciate. More and more families and professionals wanted to live in Albany. At the same time, prices throughout the San Francisco Bay Area shot up. The bungalow was now worth $675,000, and with the mortgage long since paid off, Tyson owned it free and clear. The bungalow was now Tyson's most valuable asset, and as he neared retirement, Tyson considered ways in which to tap into the totally unintended pool of equity that sat next door. Tyson looked into a 1031 exchange, but that did not appeal to him. He was an accidental real estate investor, and he did not really want to own more real estate. He looked into selling the house, but didn't quite like the idea of paying a capital gains tax. Then Tyson learned from a lawyer friend about charitable remainder trusts, or CRTs. By placing the house in a CRT, the house could be sold tax-free. While the sales proceeds pass into a charity upon the donor's death, the trust pays the individual an income in the form of an annual fixed dollar amount or a fixed percentage of the assets or proceeds value. Because he had never married, Tyson had no children to consider for estate planning, so he liked the idea of being able to benefit his favorite charity. And because charity begins at home, he also liked the idea of fixed annual income through his retirement years. The lawyer made certain Tyson understood the key downsides to using a CRT. Once established, the trust was irrevocable, meaning that the principal was beyond his control. If Tyson had a medical emergency or wanted to send his nephew to college, the trust monies, absent his annual payments, could not be accessed. Tyson acknowledged his understanding, and with that, his lawyer friend set up the CRT, and the house next door was contributed into the trust. The house was sold by the CRT without having to recognize any capital gains. The proceeds were then invested into low-risk bonds and index funds. The CRT provided that Tyson would receive a 6% annual payment based on the total value of the trust's assets. The result was that Tyson received $40,000 a year from the trust. This money was subject to income tax, but when Tyson was fully retired, he was in a lower tax bracket. Tyson appreciated the annual income he received and the irony of how his retirement plan came about. Once a year at the annual 4th of July picnic, he and the old neighbors turned up the Grateful Dead real loud and remembered the rowdies and the rich rewards for getting rid of them. Let's look at an example of how this comes into play. Carrie owned an old Victorian house located near the university. The house had been renovated so that it now contained 2 apartments. A professor, his wife, and 2 young daughters lived on the top floor. They were always timely with their rental payments. Jake, a herpetologist, lived on the first floor. He was forgetful with his rent and about whether his amphibians, snakes, and other crawling creatures were in their cages or not. Needless to say, the professor, his wife, and especially their children did not enjoy the creepy crawlers on the stairways and on the porch. They had complained more than once to Carrie. She began to realize that Jake was a problematic tenant, and she would have to do something about it. Jake's lease was a periodic month-to-month agreement, yet he usually forgot to pay the rent on time, if at all. Carrie knew from her previous experience with rentals that Jake's periodic lease only required her to give him 30 days' notice in order to terminate the lease. If he did not move out by the time the 30 days were up, she would be able to evict him. However, Carrie knew if she didn't do something sooner than that, she might lose the responsible tenants upstairs. Once Jake was late with his next payment, Carrie contacted her attorney to see if there was anything she could do. The attorney advised Carrie to serve Jake with a 3-day notice to pay rent or leave the property. The notice also stated that if the rent was not paid within 3 days, the landlord would terminate the lease and take hold of the property. After 4 days, Jake called Carrie and said he was ready to pay the rent. Carrie refused to take the rent, telling Jake that he had missed the deadline and he now must vacate the apartment. Jake hung up the phone while hissing expletives. Carrie went to her attorney and asked him to file an unlawful detainer action to evict Jake, who claimed that he had tried to pay Carrie the rent he owed, but that she would not accept it. However, the court noted that Jake's lease agreement was terminated only after he had not paid the rent within the 3 days stated in the notice, and that Carrie had opted to forfeit Jake's right to possession. Jake and his creepy crawlers were evicted from the building. This example illustrates that sometimes you do not have to wait the required 30 days or more to end a lease agreement. If a tenant refuses to leave the property, eviction proceedings must follow. If the tenant still doesn't leave after you've won your eviction proceeding, the sheriff may have to be called in to forcibly remove the tenant. Some states differ on these laws. For example, some states serve a 5-day notice instead of a 3-day notice. In order to learn your state's laws, consult with an attorney in your area. But of even greater consequence than notice is landlord liability. Now that we have maximized our tax advantages, let's learn the legal side of things. As soon as you are in contract to buy that first piece of property, you need to start thinking about how to protect it. And if you already own real estate in your individual name, you must immediately consider the many risks of such ownership and the legal advantages our legal system offers you to better protect yourself. Please note that when we speak of protection, we are speaking in very broad terms. We want to protect not only the property you will or have acquired, but also all of your personal property, your other real estate, and your other assets as well. The concern for protection is basic. Real estate involves risk, and when risk is not properly managed, demands, litigation, and money judgments can arise. These can lead to the exposure and loss of your personal assets. Real estate also involves obligations. You will sign contracts and agreements and mortgage documents, and there is a risk that you may not be able to perform all of the promises you have made. Will you be personally responsible for all of your obligations? It is imperative that you know the legal and financial risks before you buy a property. And once again, equally important is knowing, appreciating, and actually implementing the legal advantages our laws and courts afford you. The legal relationship between landlords and tenants can be traced to medieval Europe, when the king reigned over all the land. The king would allow a select group of lords to each take control of a parcel of land in return for their contributions of money, military service, favors, and loyalty. The lord was given absolute control over his parcel of land and answered to no one except the king. This is the origin of the term landlord, the idea of one being the lord over his land. In order to lord over your real estate, it is important to know the 4 types of ownership. 1. Fee estates, also known as fee simple absolute. This is the most desirable type of ownership, since it allows you to do what you want with the land. Sell, lease, or give it away if you see fit. Number 2. Life estates. This interest occurs when the title holder grants the tenant possession of the property, lasting the tenant's lifetime. The lifetime tenant is responsible for taxes and repairs until his or her death, at which time the possession of the house reverts back to the title holder. Number 3. Estates at will. This occurs when a fee owner allows a tenant to use the property for free. It terminates at the will of the owner once he or she has given the tenant proper notice. 4. Leasehold estates. This is the typical landlord-tenant agreement in which the fee owner retains the title while the tenant possesses and uses the property for the term of the lease. There are different types of leasehold estates characterized by their measure of time and term. These variations are a fixed-term tenancy, or a lease. At the date of termination, the tenant's possession automatically comes to an end. However, entering into a new lease at this time can extend the agreement and continue the tenancy. A periodic tenancy, or a rental. The most common type of periodic tenancy is a month-to-month agreement. A 30-day notice of termination from either the landlord or the tenant is considered to be proper notice. A tenancy at will. A tenant possesses the property for an undetermined amount of time without making payments. The agreement terminates with the death of either the tenant or the landlord. when terminating the agreement before such an event, the landlord must give the tenant proper notice. As a landlord, you will want to evict a tenant at some point. While this is not something that anyone likes to do, owning rentals is a business, so any tenant who is not paying what is owed or is otherwise hurting your business must be removed. As a landlord, it is important that you are knowledgeable about eviction laws in order to properly serve your tenants and to protect yourself against lawsuits. The need for landlords to legally protect their assets stems from the heavy responsibilities the laws impose on landlords in managing their properties. Consider the following case. Karen lived in Viewmont, which in the last 5 years had been discovered. Now it was a regular occurrence for people from large cities and suburbs to move into the scenic mountain town. Karen decided to turn her quaint, 2-bedroom brick house near the town square into a rental property. She then bought a larger house in a new development on the outskirts of town. Karen felt that both properties should continue to appreciate in value as Viewmont's population swelled. Karen was the only psychologist for a 100-mile radius and had managed her small practice very well. She quickly understood the business of a first-time landlord and screened prospective tenants until she settled on a couple of artists, Guy and Bruce, who came with impeccable references. They proved a good choice. They paid the rent on time, kept the house clean and tastefully decorated, and showed a talent for gardening. The only problem was the walkway to the front porch. It was uneven and cracked due to tree roots underneath. Guy had tripped on one of the large cracks and had asked Karen to fix it. Guy suggested that at the very least, better lighting on the walkway was needed so the cracks would be highlighted on dark evenings. Karen said she would consider the requests, but nothing was ever done. 3 months later, Viewmont was hit with a series of fierce winter storms. The mercury plunged, the drifts piled up and froze over, turning the city streets into empty corridors of ice for several days. Karen drove her truck over to the rental house as soon as she could. She left her tenants a snow shovel and a bag of de-icing pellets. As the residents of Viewmont dug out of the blizzard, another storm rolled in. Davy, an acquaintance of Guy and Bruce's, visited late one evening. The uneven walkway was frozen and, as usual, not well lit. Davy slipped and fell hard, fracturing his elbow and smacking his head so hard he suffered a bad concussion. He racked up tens of thousands of dollars in medical bills and could not return to his waiter's job for several months. Davy sued not only Guy and Bruce, but Karen too. Through his attorney, Davy claimed that Karen should have ensured that there was adequate lighting at the house and the walkway was properly maintained. Karen, through her attorney, said her tenants were responsible for such maintenance. The case went to trial, and a jury sided with Davy. The fact that Karen had known the walkway was not well lit and could be dangerous, even bringing a shovel and a de-icer to her tenants, was determinative. The jury applied the law as it exists in most states. If the landlord is aware of a dangerous condition on his or her leased premises and does not take steps to remedy such a condition, the landlord can be held liable for injuries resulting to others. Karen's insurance company asserted that she had wrongfully allowed a dangerous condition to exist on the property and declined coverage of her claim. Karen had not taken steps to protect her assets. She lost a great deal of them at trial. Over time, the legal concept of duty of care has evolved in concert with another concept, public policy. Public policy is the overall vision guiding jurists and lawmakers to achieve a social good. In the case of Karen's walkway, that social good is the prevention of unnecessary and avoidable injuries to innocents such as Davy, who was just walking to his friend's front door. Case law and legislation by lawmakers across the country have established the public policy that landlords exercise reasonable care in managing their properties to prevent foreseeable injuries to others. This duty of care is owed by landlords to all people, whether they live on the premises are visiting as guests, or even trespassing. That last category pushed the concept of duty of care into a gray area. Resulting public outcry after several court decisions held that property owners owed a duty of care to those injured while illegally on a property led to laws in many states negating landlord liability to criminals. Aside from that exception, a landlord who is cognizant of a perilous situation on his or her property will be held responsible for injuries incurred on that property. And if a landlord fails to carry an easily purchased and reasonably priced insurance policy, it can cost the landlord even more. Whether your insurance company will cover the claim is a separate issue. Inherent in the duty of care to prevent injuries is that a landlord has a duty to inspect the property for unsafe conditions. A reasonable inspection is required every time the landlord renews, extends, or first enters into a rental agreement. Negligence in inspecting the premises at such times leaves the landlord vulnerable later on to being charged with foreknowledge of an unsafe condition that the landlord should have found during the inspection. In addition, a landlord's duties may include an affirmative requirement to warn tenants of current problems. Laws vary by state, but certain decisions in one state, often it seems California, that may seem outrageous at the time, end up being adopted into the mainstream. Here's an example of such a California case. Roberto owned a 4-unit apartment complex across town from his house. Times were tough, and the town's vacancy rate for tenants rose, so Roberto relaxed his policy of a minimum 6-month lease and went to month to fill up his investment property, which now had 2 empty units. A recently divorced mother and her teenage daughter moved into one of these units. No red flags went up in Roberto's mind because the mother was gainfully employed, passed the credit check, and prepaid the first and last month's rent, plus the damage deposit. It wasn't until 3 months later that the other tenants began complaining about music blaring late at night from the mother and daughter's apartment. Roberto left several unanswered messages and even stopped by during the day, but no one came to the door. He mailed a notice to the mother warning her about the loud music and pointing out that the landlord-tenant contract forbade such behavior. A week later, Roberto discovered spray-painted graffiti on the retaining wall of the parking lot. He knocked on the door of another tenant's apartment. Velma, a retired nurse and longtime tenant, told Roberto that rowdy adolescents frequented the new tenant's apartment late at night. In fact, since nothing had been done about the pounding music, Velma was ready to file a police report. Why, Roberto asked, wasn't the teenage girl's mother controlling her daughter and her friends? Velma replied that she believed that the mother had gotten a new sales job with a pharmaceutical company and was often out of town. Roberto filed a police report about the graffiti vandalism. Then he consulted his lawyer and began eviction procedures. He sent a 30-day notice to terminate the mother's lease. Roberto's luck seemed to be looking up when, the following week, he succeeded in renting the empty 4th unit to a new tenant, Priscilla. She was a quiet, serious schoolteacher and agreed to put down extra money on her damage deposit since she owned a cat. Priscilla wasn't so lucky. 2 weekends later, a drunken driver plowed into her car as she was pulling into the parking lot after seeing a movie. Though she was wearing her seat restraint, she suffered whiplash and a broken nose. Her Honda Civic was nearly totaled. The other driver, who was pulling out quickly without the headlights on, was a minor who had become intoxicated at the problem apartment. Roberto was named in Priscilla's lawsuit. The court ruled in her favor, finding that the landlord, who was well aware of criminal activity at his apartment complex, owed a duty to his tenants to either provide extra security while problems persisted or to warn his new tenant of the danger. The judge held that Roberto's failure to perform either of these duties created a risk that Priscilla or other tenants might suffer harm. She was awarded damages. This is the law in California and several other states. As it may become the law in other states over time, you need to plan and act accordingly. A landlord is legally bound to rent property fit for human occupancy. It is a responsibility you cannot delegate to a property manager. Although the property manager is hired to notify you about problems and needs of the property, the buck stops with you in the eyes of the law. In fact, you are responsible for your property manager's actions as well. In light of all this, it is clear that landlords bear far-reaching liability for their investment or rental real estate. As a landlord, your greatest risk will stem from dangerous conditions you allow on your property. These conditions include, but aren't limited to, poorly maintained locks, doors, gates, lights, walkways, and safety measures, broken fixtures, unfinished repairs, continuous criminal activity, and dangerous animals. Your first concern should be to never let such conditions arise. Tend to your property conscientiously, keeping it well maintained and in good repair. Give your tenants a clean, decent, safe place to live. Of course, problems can come straight out of the blue. No matter how unexpected, fluky, or downright bizarre the happenstance may be, responsibility for any resulting damage will fall squarely on you. You're the landlord, you're responsible, it's that plain. So you must take the intelligent steps to protect yourself. The two primary ways of protecting yourself are insurance and entity usage. Let's look at a case involving insurance coverage. Greg and Benjamin were old friends from college who recently began investing in real estate. They bought 2 buildings next door to each other on Monroe Street, in an old area of the city that had recently been renovated into a bustling neighborhood of boutique shops, galleries, and jazz cafes. The old brick buildings had been turned into apartments that were in high demand because of their new, cool location. Though they both knew they had made a great investment, their management philosophies could not have differed more. Greg could be described as a bit of a risk taker. He decided to pay for only the minimum liability insurance and held the property in his own name because he didn't want to pay the initial and continuing fees of a limited liability entity. Benjamin was much more cautious. He purchased a comprehensive commercial insurance package which included liability insurance covering any injuries to third parties on the property. Since he would be hiring people to do repairs and maintenance, he made sure he covered any injuries to them by purchasing a workers' compensation policy. His insurance also covered any additional construction costs required to bring the building up to code. He was also covered for loss of rent should more construction or another interruption take place. Additionally, he bought an umbrella override policy that offered another $2 million in extra protection. After consulting with his attorney, he decided to hold the property in a limited liability entity instead of in his own name so he could never be personally held liable in the event of a lawsuit. It took an unexpected accident for the 2 friends to realize the true value of proper coverage. One winter afternoon, after an unusually bad snowstorm, followed by a week of rain, floods plagued the city. With the location of the 2 apartment buildings at the bottom of a hill, the damage to the Monroe Street buildings was particularly severe. To Greg's and Benjamin's relief, no one had been injured in the flood. However, the flood had damaged the personal property of almost every tenant in both buildings. One of Greg's tenants, Sandra, who worked from home, had all her files and business equipment destroyed. She would not be able to work for months. After all the tenants had been relocated and things had started to settle down, Greg and Benjamin had to take a close look at rebuilding costs. The city notified Greg and Benjamin that if they chose to rebuild, the new buildings would have to be built to code, including handicap access and flood abatement regulations. Because the buildings were positioned at the bottom of a hill, these additions were not going to be cheap. However, because of Benjamin's comprehensive coverage that included increased construction costs, the additions were covered by his insurance. Benjamin had also received a monthly payment from the insurance company to pay his mortgage and other expenses while he was not receiving rent. His insurance was able to handle all of the claims filed by his tenants for their property damage. Greg's situation, on the other hand, was causing him quite the headache. His insurance would only cover exactly what was lost, the older building. Any cost to construct the required improvements would have to be paid with Greg's own money. The insurance company did not cover lost rent or mortgage payments. In addition, Greg's tenant Sandra would not be able to work for quite some time because of her business losses, and Greg's low liability level was not enough to cover her claim. Because he held the apartment building in his own name, he could expect that Sandra's attorney would seek to recover from Greg's personal assets. All of these extra expenses had to be paid out of Greg's own money. Greg was forced into bankruptcy and had to sell the land on Monroe Street. Benjamin was able to purchase Greg's land from him, a move that aided them both. The plans for a new apartment building with 8 units were approved. Benjamin made sure the new building was properly insured and was held in a limited liability entity. Even though Benjamin knew that the probability of another freak accident occurring was slim, he also knew how reassuring it was to be fully covered. While insurance is the first line of defense, the correct use of entities is the second line of defense. And given the track record of the insurance industry in providing consistent, reliable, and exception-free coverage, the use of entities as a second line of defense is a necessity. Limited liability companies and limited partnerships are the entities of choice for protecting your real estate holdings. Why is that? Because limited liability companies, or LLCs, and limited partnerships, or LPs, provide the greatest asset protection possible. Unlike a corporation, where a creditor can attach your shares and control the company, in most states a creditor cannot assert voting control over your LLC or LP interests. Instead, they only obtain what is known as a charging order, the right to receive distributions from the entity. And because you remain in control, what if you decide not to make any distributions? The creditor gets nothing. But then who pays the taxes on any undistributed gains? Until the IRS rules otherwise, the creditor pays the taxes. It is not attractive for creditors to obtain a charging order where the result is that no distributions are received, and yet taxes must be paid on any undistributed profits. In fact, knowing that your assets are held in LLCs and LPs may be enough to prevent a lawsuit from being brought in the first place. That said, there are several key points to discuss in regards to asset protecting your real estate. First, be aware of corporate and legal form promoters who guarantee 100% bulletproof asset protection. Yes, you'll be better protected by using these entities, but no one in good conscience can offer a 100% guarantee. Laws change, and future court decisions may minimize current protections. Please be very clear that someone who offers a 100% asset protection guarantee is 100% of the time trying to separate you from your money. Second, in California, there are court cases that have minimized the protection of LLCs and LPs. And there is a bankruptcy case in Colorado that has minimized protections. Other states may follow. So how do you deal with these less than favorable decisions in California, Colorado, and other states with plaintiff-friendly court systems? The best defense is to organize your LLCs and LPs in the 2 states that have excellent asset protection laws in place, Nevada and Wyoming. Both have statutorily enshrined the charging order as the exclusive remedy for creditors. As we've discussed, that is not a satisfactory means for collecting money, and thus it is both an aid towards settlement and a deterrent to litigation in the first place. Suppose you acquire a large apartment building in California. You know you need to use a protective entity, but are aware that California law, or your own home state's law, does not offer the best protection. How do you deal with this situation? Before we discuss asset protection, we need to consider a state taxation issue. California and Texas have an extra tax on LLCs. If you have gross receipts of $250,000 a year or more in your LLC, you pay an extra tax to the state of California. At a minimum, the tax is $800, but with millions in gross receipts, you will find yourself paying thousands of extra dollars for the privilege of using an LLC in California. So on larger properties, you'll use a limited partnership, which is not assessed the extra gross receipts tax. Texas also has an extra franchise tax on LLCs, 4% on profits over $125,000 a year, which leads many to use LPs in that state as well. Of course, the issue with the LPs is that they require a general partner to manage them. And a general partner is personally responsible for everything that happens in a limited partnership. So if you list yourself as an individual, you haven't really protected yourself. You're still personally responsible. Thus, the key to using an LP is to make sure that the general partner is another corporation or LLC. In this way, you encapsulate the unlimited liability of the general partner into a limited liability entity. So for California, Texas, and all other states, your LP structure will look like this. With as little as 2% ownership, the general partner can exert complete control over the affairs of the limited partnership. This is an excellent way to handle properties with family members or investors involved. As limited partners, they can be restricted from asserting demands or control over the investment. Absent fraud, the general partner reigns supreme. The problem with properly structuring a limited partnership is that it requires the formation and maintenance of not one entity, but two. To do it right, you need not only a limited partnership, but a corporation or LLC to serve as the general partner. In an expensive state like California, where the annual entity fee is $800 per year, the cost can add up. But there are 2 points to remember. First, the extra $800 a year may pale in comparison to the many thousands of dollars in extra California or Texas state taxes to be paid on an active LLC. Second, you can use your corporation or LLC to be the general partner of more than one LP. In other words, you only need to pay the formation fee, an annual $800 fee in California, once, not every time you form a new LP. An example is as follows. ABC Management, Inc. is the corporate general partner for 3 separate limited partnerships. The 3 LPs own real estate in California, but want the better asset protection features of Nevada and Wyoming law. How can this be accomplished? Very easily. First, you form the LPs in Nevada or Wyoming. It is suggested with multiple entities that some be formed in Nevada and some in Wyoming. In this way, if a plaintiff is coming after you, he may have to fight not in one state, but 2. The use of multiple favorable jurisdictions can be a deterrent to litigation. Once the corporate general partner and the LPs are formed in Nevada and/or Wyoming, then you must qualify them to do business in the home state where the real estate is located. This is a fairly simple process and brings you into the home state's tax system. Let's assume you own 3 apartment buildings in California. You form ABC Management, Inc. and LMN LP in Nevada. RST LP and XYZ LP are formed in Wyoming. All 4 entities are then properly qualified to do business in California, a process that involves presenting the out-of-state formation documents to the California Secretary of State's office and paying the annual fee. How will asset protection work in this case? First, we must distinguish the types of attacks that may be brought. The first attack is brought by a tenant who falls at the apartment owned by LMN LP. Can this tenant get a judgment and reach the assets of RST and XYZ? No, his claim is against LMN. The other real estate and your personal assets are protected by using LLCs and LPs. But under California law, because the claim involves the real estate and the real estate is located in California, California law applies. And California law, under current precedent, could allow the tenant to reach the assets within LMN, being just the apartment building. But again, remember, even in this liberal California scenario, the tenant does not reach your other assets. The second attack can come as a claim not involving the real estate. Suppose you get in a car wreck and your insurance has lapsed. The claim has nothing to do with the apartment buildings you own. The attack then comes not at the operational level, but at the ownership level. Because attack number 2 does not involve the real estate but is rather an outside claim, the law of the state in which you are organized will in a vast majority of the cases be the law that is applied. And by organizing in Nevada and/or Wyoming, a creditor is going to have to live with the charging order procedure as the exclusive remedy. As we've seen, the charging order is not a sure path toward collection and is thus a deterrent to litigation. Additional information on the proper use of LLCs and LPs can be found in my book, How to Use Limited Liability Companies and Limited Partnerships.